The first stock that I'm buying in January of 2025 is one that I have been buying for the past few months, and it is already the third largest position in my portfolio. I will be surprised to see it at number 2 or even number 1 in a few months, and that stock is of course Crocs. The market has overreacted from the last earnings of Crocs. The company had great earnings if you're going to ask me. But there was something that the market didn't like about those earnings of Crocs. And besides, the market has been unhappy about the performance of Crocs for the past couple of quarters, if you think about it. And that is because of Hey Dude, which is a company that Crocs acquired a few years ago. If we're going to look at the price at which Crocs paid for Hey Dude, I believe that they overpaid for it. That there was this big trend on Hey Dude and they acquired this company thinking that it was going to continue. But this did not happen. But what we need to look at today as investors is whether the market's reaction is proper or not. And most of the time, it's not proper at all. And here the mistake that the market made was to look at Hey Dude as if it is losing money. But the company is profitable. It is true that the revenues are not growing as it was expected before, but that doesn't mean that Crocs is losing money on Hey Dude. And today there is no reason at all to justify Crocs as a business trading at 8 times, 7 times earnings. I bought shares when it was below $100 a share, and I hope I have bought more. I hope the stock price keeps dropping so that I can buy more shares, because at 7 times earning, this is one of the most undervalued companies in the US markets today. This is not a company that you can expect to grow over the long term at a fast rate. It is not a fast growing company, but nevertheless it is undervalued today. There is nothing to justify 7 times, 8 times earnings. Even if we ignore Hey Dude, let's assume that the acquisition never happened. Crocs is still a wonderful company trading at 8 times earnings. And if we include Hey Dude, which is bringing profit to Crocs, the acquisition was bad, that was years ago, but the profits are here. We need to count them. And in a way, it is good that Crocs is not investing that much money into Hey Dude. It's better to keep the margins high, because Crocs is one of the businesses with the highest margins. They are one of the most efficient companies compared to their competitors. I mean, it's not a tech company, but the numbers, the margins, it looks like a tech company requiring little capital to grow, to maintain current operations. And the business has a very strong brand. I was a little skeptical at first to invest so much in Crocs because it's retail and I like to take a big margin of safety. But after the last earnings, I invested heavily in Crocs because now my margin of safety is here. This is not the case for the second stock I'm going to buy in January of 2025. I built a small position. I'm not sure if I'm going to buy more, but I hope so if the stock price keeps dropping, and that is CELH. With CELH too, there has been some issues with the market not understanding what's happening. Mr. Market is quite stupid. It happens a lot, but you have to be smart about it and know how to invest. What's happening with CELH, which is a beverage company, they are making energy drinks which are healthier compared to Monster or Red Bull. We know that people love these energy drinks, but they are not that healthy. And people want to be healthy also. There is this shift in consumer habits about healthier products. So why not make healthy energy drinks? And CELH have been making these for years. Recently, they partnered with Pepsi. Pepsi is now their distributor in the United States, which is something big. It brings a lot of value. Because if you think about it, Pepsi, one of the largest beverage companies in the world, the second largest beverage company in the world after Coca-Cola, the second largest food company in the world after Nestle. They have this wide distribution network. They have all the logistics, everything put in place. And CELH is just here making the products, selling them to Pepsi, and Pepsi is handling the rest. But Pepsi made a mistake. They thought that the sales of CELH was going to keep growing at a fast rate, and they ordered a lot. So they had a lot of inventory. That's why the sales of CELH a few years ago were so high. Mainly it was pushed by Pepsi. But what happened later was that Pepsi realized that they overbought, that the demand from consumers is big, but it's not that big as they were expecting. And they had to lower inventory and not buy so much anymore from CELH. That's why the revenue growth of CELH declined considerably. While the market was valuing on CELH was not the earnings, was not even revenues, but revenue growth. And when the market sees that revenue growth is declining, that means that the stock price should go down according to the market. But if you're going to consider now that CELH can enter the international market, only in 2024 that CELH entered a few foreign countries. Even Canada, only this year CELH entered this market, even though some people might say it's part of the US like Greenland and Panama. Let's not talk about this. Why I'm not buying so much is because I need a margin of safety. It is undervalued. I have been conservative with my analysis. You can find everything on the Superinvestors Club. On the Superinvestors Club, I post all my research, all my analysis. There's an investing course for beginners, an investing course on how to read financial reports. You can find everything that I do there about investing, and soon I'm working on a new course about how to actually value businesses. If you're interested, please check it out. It also helps this channel. Now let's talk about the third stock I'm buying in January of 2025. It's another one a little similar to CELH, how the market valued CELH based on high revenue growth. This one is Evolution Gaming, or Evolution AP now they call themselves. It's a live casino business. You have to understand that I don't know if you're familiar with the online gaming. I'm not so familiar with it. I don't play, I don't gamble, but it's a good business. Let's say you want to play blackjack, but you're too lazy to go into a real casino and play. And many people are becoming lazier and lazier. They want to play online, but you still want the human interaction. So what Evolution is going to do, they are going to have these live studios where there is the dealer. The game is the same, but it's in front of a screen for the consumer. They don't operate the games themselves. So if you want to play, you don't play directly with Evolution. You go through those online casino operators. In a way, it means that the operating cost of Evolution is low. It is a very efficient company growing at a fast rate. The issue is, of course, regulation, and last week the stock price fell by 10% in one day. It's because regulators were looking at the company in the UK, which is only 3% of their market. So I don't know what will happen, but I believe the market overreacted to this because it's 3% of the market and the stock price dropped by 10%. But regulators in the UK also means maybe in the future regulators in other countries. Not all of their market is regulated. That's something to consider. But it's not really about Evolution. It's mostly about the operators of those casinos that need to be regulated. But of course, if these companies are banned, then business of Evolution also is going to suffer. There were also other issues with the company. For example, in Georgia, the country, the state, where they have one of the largest studios, and there have been some strikes there among their employees, and it's causing some issues with the stock price. Should we be worried about all of this? Yes, but the stock price today, it is undervalued compared to everything that is happening. This is what you have to look at. The value and the price. The price is lower than the value. I am not buying shares of Evolution that much because of my big exposure on FDJ. FDJ is a monopoly in France, the lottery monopoly in France. They are entering the online casino market through their latest acquisitions of Kindred and other acquisitions they made recently. But this is not a direct competitor to Evolution. In fact, FDJ is one of the customers of Evolution, and FDJ is 100% regulated. Everywhere they operate, they are 100% regulated. But you will see something interesting, that the stock price of FDJ and Evolution is correlated for some reason. Because when the market sees gambling, it's the same for them, for the Mr. Market. I told you Mr. Market is stupid. But this is not what investing is about. Now, if I have 20% of my portfolio in FDJ, I should be careful investing in Evolution. Both are undervalued. I believe that Evolution has a higher growth prospect, but FDJ is safer. So I have to look at both of that and try to make a balance where to put my money. If I had discovered Evolution before, I saw that it was undervalued before, maybe I would have invested about the same amount in both. But now I have to consider that I have FDJ in my portfolio and need to be careful before investing too much in Evolution. If you want to learn more about Evolution, I would recommend you watch this video next. Have a nice day and goodbye.